standing by, and welcome to the Limeade Second Quarter Investor Conference Call. All participants are in a listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, you will need to press the star key followed by the number 1 on your telephone keypad. I would now like to hand the conference over to Mr. Henry Albrecht, CEO. Please go ahead.
Thank you, operator. Limeade CEO Henry Albrecht here, presenting our cash flow results for the first quarter ended 30 June 2022, Q2 2022. Joining me today is Limeade CFO Todd Sparks, and I'll start today's call on the main takeaways for the quarter. Starting with net revenue retention, or NRR, we ended at 99% as at 30 June 2022, compared to 100% as at 31 March 2022. It's also increased from the prior corresponding period, which was 93% NRR in 2021 at this time. Limeade also has much less exposure to indirect channel for our well-being solution now, which negatively impacted the prior corresponding period's churn. We signed 47 new customer agreements for $0.6 million of contracted annual recurring revenue, or CAR, in Q2 versus 60 customers and $0.7 million of CAR in Q1 2022. The majority of these were Limeade Advanced Listening Solutions sold to mid-market customers. As a reminder to investors on today's call, Limeade Wellbeing and Limeade EX are seasonal businesses, with the majority of deals historically closing in the second half of the year. The company's sales pipeline at Q2 2022 was $43.4 million, including $18 million in finalist and verbal stages, compared to the prior period sales pipeline of $42.6 million with $9 million in finalist and verbal stages. This is an increase of 99% with rounding in finalist and verbal pipeline versus Q2 2021, and 10% higher than Q1 2022, showing that we've seen solid pipeline progression both quarter over quarter and especially versus 2021. Cash and recurring subscription revenue from the existing customer base remains strong, with the top 20 enterprise customers on average having 16 months remaining on their contracts, down 1 month from 17 months at the same at the prior quarter, Q1 2022. Todd will discuss this in detail shortly, but our cash position was $2.5 million as at 30 June 2022, with a $15 million debt facility in place. We're also today reconfirming our market guidance for revenue, EBITDA, and net loss for FY22. In addition, the strength of the late-stage pipeline, coupled with the very solid net revenue retention achieved year to date, provides us confidence that Limeade will potentially see organic year-over-year CAR growth in 2022, as we have mentioned in prior meetings as well. We remain committed to achieving a sustainable cash flow break-even position by year-end 2023, and are reconfirming that today. During the quarter, we continued to invest in our technology platform while also diligently managing our costs, with staff costs, admin and corporate costs, and R&D expenses all significantly lower in Q2 versus Q1. Limeade strengthened its leadership team during the quarter with the appointment of Kathy Xanthos, Chief Information Security Officer, or CISO. Kathy is a highly regarded and experienced technology, healthcare, and cybersecurity expert, and a welcome addition to the Limeade team. I will now turn the call over to Todd Sparks, Limeade CFO, who will provide a summary of our quarterly cash flow information as released to the ASX this morning. Todd?
Thank you, Henry. During the quarter, the company recorded cash receipts from customers of $13 million, down 5% versus the PCP, or prior comparable period, reflecting a decrease in payments due to customer churn. Net cash receipts from customers, after adjusting for payments made in relation to the sale of third-party products and services, was $10.9 million, up 5% versus the PCP. Third-party payments of down 38% versus the PCP and sequentially down 32% when compared to Q1 2022. Cash payments during the quarter were directed towards the following costs: staff, $10 million, admin and corporate, $3 million, operating, $0.9 million, marketing, $0.6 million, and research and development, $1 million. The 16% increase in quarterly staff costs versus the PCP reflects the additional headcount from the TinyPulse acquisition. On a sequential basis from Q1 2022, staff costs were down 17%. The 87% increase in R&D spend versus the PCP reflects the acquisition of the TinyPulse R&D Center of Excellence in Vietnam. On a sequential basis from Q1 2022, R&D expenses were down 45% due to insourcing and centralization of third-party services. Overall, the company recorded operating cash outflows of $4.8 million for the quarter versus $2 million in operating cash flows in Q2 2021. Investing cash flows for the quarter were $1.4 million, an increase of 79% over the PCP of $0.8 million, reflecting Limeade capitalized software development costs incurred for the consolidated company, which now includes TinyPulse. I wanted to now talk about the company's cash position in more detail, as I'm sure investors are focused on that number today in particular. The company's cash balance as at 30 June 2022 was $2.5 million, down from $8.7 million at Q1 2022. At the quarter end, the company remains debt-free. In addition, the company maintains a $15 million debt facility with Comerica Bank. As a reminder, as an enterprise-focused business that often sees annual in-advance payments, there is significant monthly and quarterly variability in the timing of our cash receipts. Limeade has implemented several steps to manage our cash position as we track towards a higher forecasted year-end cash position and a forecasted year-end 2023 cash flow break-even point. Further details of our strategy for managing cash and cash flows will be outlined at the presentation of our first half results. Turning now to our guidance for FY22, Limeade is pleased to reconfirm guidance as follows: pro forma revenue of $55 to $58 million, pro forma adjusted EBITDA loss of $6 to $8 million, pro forma net loss after tax of $8 to $11 million. To remind investors, pro forma revenue includes the adjustment to TinyPulse deferred revenue, which was required as part of the purchase accounting under US GAAP. And pro forma adjusted EBITDA loss includes the deferred revenue adjustment and excludes stock-based compensation expense. Finally, the pro forma net loss after tax includes deferred revenue adjustment. I will now turn the call back over to Henry for concluding remarks ahead of Q&A. Henry?
Thank you, Todd. I'm happy to report Limeade remains a leader in immersive employee well-being solutions that create healthy employee experiences. I note a recent article from the Bureau of Labor Statistics here in the United States in July relating to April 2022 data, and I quote, "Americans quitting their jobs comprised 60% of all job separations in February 2020. Quits were 18% of all job separations in April 2020. An 8-year low. Two years later, so that was 2020. 2 years later, quit rates were at a 22-year high, with 4.4 million people quitting in April 2022, making up 73% of all separations. It's therefore quite timely to mention that Limeade solutions create connection, clarity, and cultures where well-being matters for the customers we serve. We know from our research at the Limeade Institute that Limeade participants turn over at 1/3 the rate of non-participants. Limeade is poised to take advantage of this market opportunity. We remain confident in our pipeline in our business plans for the remainder of 2022 and eagerly anticipate our return to organic car growth for the year and an improvement in our cash position through measured operational cost controls. I'd now like to hand over to the operator for the question and answer session. Thank you.
Thank you. If you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press star 2. If you're on a speakerphone, please pick up the handset to ask your question. We will now pause a moment to allow for any questioners to register. There are no questions. Pardon me, your first question comes from Josh Goodwill with Shaw and Partners. Please go ahead.
Morning, guys. Thanks for taking my question. Just firstly, in terms of the pipeline that you're seeing, obviously it's growing quite nicely and bigger year on year. I was wondering if you could give a bit of colour on the mix of advanced listening versus wellbeing and EF that you're seeing within that pipeline.
Yes, I'd be happy to. Thanks, Josh. Appreciate the question. Although we're not, giving great detail into the makeup of the pipeline, it's safe to assume that the vast majority of that late-stage pipeline in finalist and in verbal award, which is in contracting negotiations, is in the core well-being part of our business, which are large enterprise transactions. Not to say we have a weak or poor pipeline in other parts of the business, but the vast majority is in the core flagship well-being offering with large enterprise customers.
Thanks, Henry. And just on the cash position, I know you're planning to give a bit more detail at the half result, but just in terms of the lumpiness of the cash flows as we move through the coming quarters and with the cash position at where it is today, is there any anticipated need to draw on the debt facility that you guys have in place in the near term?
Well, let me take that in two parts. First of all, I just want to comment on that lumpiness, which you rightfully point out. I was reviewing some of our cash collections month over month, and just as a reminder, there are some months when we may collect $2 to $3 million in cash receipts from customers, and some months where we're in the $9 to $10 million range, and it varies so widely that it's important that we have that debt facility in place. Just to kind of, what I would say, be prepared to handle if there's any kind of monthly or even mild quarterly variability as well. But we have no intention to use debt as a way to kind of, in an ongoing way, fund the operational running of the business, and certainly the same could be said for equity financing at this point as well.
Thanks, Henry. That's clear. And lastly, I'll just be interested in what you're seeing from a macro perspective in terms of your selling environment over in the US at the moment. Some companies, we're getting mixed commentary basically from other companies in the sector. So I'd just be interested in your views on what you're seeing from a macro and selling environment, please.
Yeah, I would say this is one of the first years when I actually, look at the financial markets a little more regularly than we have in the past. It's been so volatile, and both the valuations and the earnings results from enterprise software companies have been all over the map. What we've seen in our own business is a very strong progression through the pipeline of the larger enterprises. So there are certainly industries, as we've discussed in the past few years, that have been hit harder than others that might be rebounding, certainly in transportation, airlines, et cetera. But this year we're seeing strength in some of the core industries that we serve well: financial services, healthcare, government, some of the manufacturing, some of the staple industries are actually doing okay in the U.S. So I would say macro, we are cautiously optimistic, but obviously watching for signs of recession and those things. But we haven't really seen, massive declines in things like employee counts. And as a company that gets paid, as a multiple of how many employees our customers have, I think we've seen continued relatively low levels of unemployment and very strong labor economy as well.
Thanks very much.
Todd, I don't know if you would add anything, but that's my take, yeah. Thanks, Josh. Appreciate your question.
Thank you. Once again, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. We'll pause a moment to allow for any final questioners to register. There are no further questions at this time. Pardon me, we do have a questioner, Sophia Owood from Macquarie. Please go ahead.
Hi guys, thanks for the result announcement today. I was just wondering if you could talk to the impacts of inflation in the US at the moment and how that's factored into your contracts, if you have escalator clauses or not.
Oh, that's a great question, Sophia. In general, when we renew our contracts with our customers, we obviously try at all times to have escalators. Some contracts do have built-in escalator clauses, some do not. And so I would say in general, we feel highly aware of inflation. Certainly, one of the biggest areas of inflation we see is wage inflation. But we've managed to see, put a good dent in the employee churn of prior years and see that trend improve. And obviously excited to have, a workforce that's a little more globally distributed in Canada, in the US, in Europe, and in Vietnam as well, which we believe that diversity is in some ways an insulator against, the biggest inflation we face, which is wage inflation, as salaries and similar costs are such a huge component of our cost structure.
Great, thank you guys.
Yeah, thank you, appreciate it.
Thank you. There are no further questions at this time. I'll now hand back to Mr. Albrecht for closing remarks.
Thank you, operator, and thank you, Todd. Thank you, Sophia and Josh, for the questions. Thank you all. We look forward to updating investors on our progress for the remainder of the year. We'll provide further detailed information on the business and the financial performance at the first half results in late August. Onward. Take care.
That does conclude our conference for today. Thank you for participating. You may now disconnect.